to another episode of the MD Investor channel where we're talking about personal finance, setting goals, achieving goals, educating ourselves and our children so we can break the cycle of generational poverty. Another video, we're going to talk about the dividends we received in November 2020. Dividends we received in November 2020. We do these videos monthly to kind of track our progress, motivate people, encourage people, so we can create passive income for ourselves. Before we get into the video, if there's people out there you think could benefit about this personal financial information during this pandemic, unprecedented time that we're going through, let them know about the MD Investor, right? We're just a regular person who is not an MBA or CPA or anything like that, but just we got sick and tired of working hard for everybody else and making everybody else rich and wealthy, and we really not getting the benefit of it. So on YouTube, it's MD Investor. On Instagram, it's MD Investor One. And without further ado, let's get into it. So we got paid from 20 different companies in November. 20 different companies in November. Okay. First one we got paid from in November was on November 2nd. That's AT&T. AT&T paid us $520.86. You already know about AT&T, the phone service carrier. They compete with Verizon. They're also involved in other things too, in terms of entertainment and so on. So let's take a quick look at AT&T. Ticker symbol T, and it's trading for about $28.87. The 52-week range and the low was $25. High is $37. So it's a pretty good time to buy it, I would say. PE ratio is 9, so fairly valued, okay, or good value, right? So you're getting a good deal. Let's look at the dividends. AT&T pays 52 cents. It pays it quarterly for $2.08 for the year divided by the share price will give you a dividend yield of 7%, which is great. The dividend yield for S&P 500 is under 2%, right? So you take the 500 biggest companies in America. Some pay dividends, some don't, right? So certain companies like Amazon and Facebook and Google and all that stuff, they don't pay dividends. But you take all the other companies that do pay dividends and they're paying you less than 2%. So that's why now you know why AT&T is such a favorite of dividend investors, right? You're getting more than 3 times what you'd get if you just bought the broad index. It's not a great growth rate, right? 2% is not great, and barely keep up with inflation. Payout ratio is pretty good, all right? So people love AT&T because of the yield, So every $100 you invest in AT&T, you're getting $7 a year back, right? Okay, let's go back to the portfolio. We got paid by JP Morgan Chase. They did a big bank. They paid us $5.87. Verizon paid us also the same day, and they paid us $17.82. Let's take a quick look at Verizon. Ticker symbol VZ. They're the competitor of AT&T, and also a pretty good dividend payer. So Verizon, ticker symbol VZ, $60.58 is what they're trading for, which is kind of toward the highs over the last 52 weeks, right? Over the last 52 weeks, the low has been $48, the high has been $61. So you buy it now, you're about at the highs, right? The PE ratio is 12, so fair valued, right? You're not getting a great deal, but it's fair valued. Let's look at the dividends. Verizon pays 62 cents, and they pay the quarterly. So annual payout is about $2.51 divided by the share price gives you a yield of about 4%. The payout ratio is also low, about 50%, and the growth rate, again, not that great, 2%, right? And they've been growing their dividends about 13%. And you'll notice that companies like the telecommunication space, they don't really grow that much. But you get regular cash flow because people are going to pay their phone bills before they do anything else, and that's where the companies get all that money from. In addition to some of the other ventures like entertainment and all that. Let's go back to the M1 portfolio. On November 4th, we got paid by Lowe's. Lowe's paid us $2.18. Lowe's competes with Home Depot. I think at Lowe's, I ticker symbol LOW. They're trading at $153.40. It's toward the high end of the last 52-week rate. The low has been $64, high is 177, PE ratio of 17. So fair value. Let's look at their dividends. They're paying 60 cents, and that's paid quarterly. So $2.40 over the year divided by the share price of this will give you a dividend yield of about 1.5%. So not great. But the good thing is that the 5-year growth rate is high. So current yield is low, but it grows its dividend very aggressively. Payout ratio is also very low, so there's room to grow their dividend. And their payout ratio, as you remember, is the percentage of the earnings being paid out as dividends. So they're paying out 27% of their earnings as dividends, and the remainder, the other 73%, is being kept back in the company to grow their company, research and development, and so on and so forth. And they've been doing this, growing the dividends for over half a century, so 57 years, which make them dividend kings. So dividend kings are companies that have been growing their dividend for at least 50 years. And the dividend aristocrats have been doing that for at least 25 years, and also are part of the S&P 500 company. So, and you're going to notice that the pattern, companies that are low in current yield, a lot of them will grow their dividends, which is what you want to see, right? And especially if you don't need the money right now to retire and you're still working, this is okay because even though the current yield is low, it's growing its dividend so rapidly that eventually you're going to get to where you need to get to in a very short time, as opposed to the opposite where you see companies with a high current yield, like AT&T, but they grow the dividend very low, very anemic, very weak. Those companies are good if you are going to retire right now, right? If you're going to retire right now and you can't wait for the growth, and you don't really need the growth, but you need current yield, companies like AT&T. And it's okay to have a mixture. And there are some companies that have a little both. They have high current yield and they also grow the dividend very aggressively. So you can't, they do have companies um, like that too. Okay, back to the portfolio. Air Products and Chemicals paid us $10.66. American Express paid us $4.01. Um, let's look at American Express for a quick minute. Ticker symbol AXP. Trading at about $119, and towards the high end, right? Over the last 52 weeks, it's been as low as $67 and as high as 134. PE ratio 35, so very richly valued. So people, have confidence in American Express. They believe it's going to come back. They got hit obviously because of the pandemic. People can't pay their credit card bills and so on. 43 cents a quarter, $1.72 for the year. Yield less than 1.5% to 1.43%. Growth, 5-year growth rate is not bad. Okay, payout ratio is low. So people are expecting that it will, you know, it will continue to grow the dividend, right? 10% is not bad, right? Double-digit dividend growth rate is always welcome. Okay, let's get back to the portfolio. Apple paid us on November 12th, and it paid us about $2.24. All right, we can move on. So we've talked about Apple before. Costco paid us on November 13th. They paid us 60 cents and 70 cents. All right. Costco, the big wholesale warehouse companies, where you go there, you get like your big jumbo, whatever you need. Um, they have been doing well. Let's look at Costco real quick. COST, ticker symbol. 7. So trading at about $387, and they're toward the high of the 52 week, right? The low over the last 52 weeks, 278, high 391. So we're toward the highs. PE ratio is almost 40, right? So it is um, very richly valued, and it's at a 52 week high. So not a great time to buy. They're paying this is yeah. So Costco, it says here last dividend. I think this $10 is a special dividend. Um, that is a special dividend um, that they're going to pay in December 11th. So for every share of Costco you have, they're going to give you $10. They're doing so well that they have so much excess cash that they're going to do this what they call special dividend, and they're going to pay them pay you $10 for every share you have. Also, a benefit of some of these companies, right? So just because you're owner of Costco and they have so much money on the books that they want to pay it off. A lot of times they do it for tax purposes too. Just like toward the end of the year, people do certain things that maybe they may give money to charity or certain things because the tax year is ending. Businesses also do it too. So this is not the regular dividend. The regular dividend is over here where you see annual payout of $2.80 and they pay it quarterly. So $2.80 divided by 4, so they pay about 70 cents per quarter. So this $10 special dividend. They've been paying it now for about or the payout ratio is about 28% for Costco, so there's room to grow. And it's a low yield, less than 1%. But they see that the growth rate is good. Double digit, 14.5% growth rate is great, okay? And you see the growth rate, pretty much almost double digit as far as you can look back. So they're doing great. Let's go back to our portfolio. November 13th, General Dynamics paid us $5.76. And that's a company that's in like they do like parts for like airplanes and some defense contracting stuff. Realty Income paid us also November 13th. That's the monthly payer. They paid us $8.42. Before we go on, let's look at our General Dynamics real quick. Ticker symbol GD. So General Dynamics trading $151, which is kind of in the mid range of its 52-week range. Low is $104, high is 185. P/E ratio 13, so fair valued. Let's look at the dividend. They pay $1.10, and they're paying this out quarterly, so $4.40 for the year. So the dividend yield is about 2.9%. The payout ratio is low, right, under 40%. The growth rate is double digits at 10, so that's good. And they've been growing their dividend for 26 years. So always welcome to see that. And the whole idea is to grow our position in these great companies. November 16th, National Retail Properties paid us $21.70. And this is a REIT or Real Estate Investment Trust. On November 16th, we also got paid by Procter & Gamble, $5.32, and Colgate-Palmolive. Colgate-Palmolive and Procter & Gamble, those are in the consumer non-discretionary space. So your Procter & Gamble is your maker of Tide, Gillette shaver, Colgate Palmolive, the Colgate toothpaste, Palmolive soap, stuff that you're going to need regardless of whether the economy is up or down. We also got paid on November 16th from PBCT, People's United Financial. It's a small regional bank headquartered in Connecticut. They paid us $133.29. We can take a quick look at PBCT. So PBCT is a like a small regional bank in Connecticut, as opposed to the large big bank like J.P. Morgan Chase, which paid us earlier in the month. So ticker symbol is PBCT. It's trading at $12.80 in the last 52-week range. In the 52-week range, it's about in the mid portion, right? The lows of about $9, highs of about $16. PE ratio is 10, so not bad. We'd say like fairly valued to good value. The dividends, let's look at the dividends here. They're paying 18 cents, and they're paying that quarterly. Those 72 cents for the year divided by the share price give you a dividend yield of 5.6%. The growth rate is not great, but the payout ratio is pretty low, and they've been doing it for about 28 years. So obviously we want to grow that, continue to grow that position. So right there you saw a little diversification, right? In the financial space, we saw J.P. Morgan Chase, we saw American Express, and we saw People's United. So even within the financial space, diversified. Okay. November 16th, we also got paid by AbbVie Labs. The correction, AbbVie, which is the pharmaceutical company. It's a spin-off of Abbott Labs. They spin off a couple of years ago into two different companies, Abbott Labs and AbbVie. AbbVie, the pharmaceutical segment. So they paid us $39.48. Let's take a look at AbbVie. I want to bring out this one point. I said before that they're companies usually with a low initial yield, like say Lowe's, right? They usually have a high growth rate, right? So it's like the inverse relationship. Low current yield, a lot of times will have a high growth rate, like Lowe's. And then high current yield will usually have a low growth rate, like AT&T. They have a high current yield, but they have a low growth rate. And then every once in a while, you have companies like AbbVie that have both. Okay, so ticker symbol ABBV, they're trading about $104, which is toward the high of the 52-week range. The PE ratio is about 9.93, so good value, good value. So it's paying $1.30, paying quarterly. That was just raised. That won't be paid out until February of 2021. They raised their dividend from $1.18 to $1.30, about 10% raise during a pandemic. How many people are getting a 10% raise during the pandemic, right? Not many. So annual pay at $5.20. The dividend yield is 5%. So high current yield and a growth rate of over 20%. So this is what I'm talking about. There's a few companies out there that have high current yield and a high growth rate. And AbbVie fits one of those, okay? Payout ratio is low, and the dividend growth is about 7, do for about 7 years. Let's get back to our M1. Now, November 16th, yeah, we got another Colgate Palmolive, okay? We already didn't mention that. Clorox paid us $3.97. Clorox, obviously, during the pandemic is doing well, and everyone needs their products and stuff. They paid us $3.97. Unilever paid us $7.33. Unilever competes with like Procter and Gamble, packaged goods, deodorant and soaps and so on. Stuff that you're gonna need regardless. Caterpillar on November 20th paid us 73 cents, and then $5.15. Obviously, due to economic slowdown during the pandemic, Caterpillar is probably not doing as well as in the past. But we're going to hold on to Caterpillar. Clorox again paid us 12 cents. So we're coming toward the end. Let's look at Caterpillar real quick. So we're coming toward the end. So let's look at Caterpillar. Caterpillar ticker symbol is CAT, trading at $173, toward the very high end of its 52-week range, right? The low has been $89, the high has been $175. PE ratio is 31, so it's richly valued. Let's look at the dividends. Caterpillar is paid $1.03, and it's paid this quarterly. Annual payout is about $4.12, right? So you take this and times 4, you get $4.12 divided by the share price, give you a yield of 2.38%. So the payout ratio is about 75%. 5-year growth rate is about 7%, 7.7%, not bad. And they've been growing the dividend for 27 years. So these are solid companies. Current yield is not great, but they're growing the dividend. It's not great. Good to have that in the portfolio. Let's go back to the M1. We're gonna finish up. Shaw Communication paid us $6.07. That's a Canadian company. It's a monthly payer. Starbucks paid us on November 27th, $16.38. Starbucks, did get hit with a pandemic. During the pandemic, they had to close all the stores in China and in the U.S. and all this stuff. But they are coming back strong. People want their coffee, so let's go to Starbucks, take a quick peek. They're trading at $98.82 toward the very high end of the 52-week range. So they're coming back. PE ratio 35. So it's high. People really have confidence and think that Starbucks is coming back. Let's look at the dividends. 45 cents paid quarterly, so $1.80 for the year. So dividend yield, current yield under 2%, or 1.8%. But the payout ratio is not bad, 64%, and 5-year growth rate, 22%. And they've been growing their dividend for 10 years. So Starbucks is a company that's aggressively growing their dividend. So that's something that even though the current yield is not high, the growth rate is very, very good. And by the rule of 72, you take 72 divided by this, you get about 3 point something. That means in about 3 years, 3 to 4 years, this dividend yield, or this dividend could be doubled, right? So they could be paying 90 cents in a couple of years, okay? So that's why people like that growth rate. Even though the current yield is not great, the growth rate is great. And back to the portfolio. And then the last day of the month, November 30th, long-term care paid us $3.91. And the total for November 2020 was $828.23. So $828.23 in passive cash flow that we did not have to work for. So we are close to our $1,000 per month goal that we set, and just want to show that little by little, if you keep investing, companies keep giving dividends, and we see how they will raise dividends. And even in the case of Costco, they're giving that special dividend because they have so much cash flow on hand, and the end of the year is coming, right? And they do their taxes just like we do our taxes, and that's one of the ways to minimize their tax burden is to give this money back to shareholders, right? Again, $10 per share, right? So you own, one share, they give you $10. You own 10 shares, you get $100, and so on. So trying to grow the cash flow, motivate, encourage, inspire people. If there's people out there you think could benefit from this content, let them know about the MD Investor. On YouTube with MD Investor. On Instagram with MD Investor 1. And remember to command your man to grow. And I will see you on the next one.